In problem 2-26, we're going to put together a cash flow statement for Wave Corporation. So when the company puts out its financial statements, it has to give a balance sheet, an income statement, a statement of changes in equity, and a cash flow statement. And basically with the cash flow statement, all we're doing is rearranging the balance sheet and the income statement and taking out all of the accruals so we can see what the company did with its cash. So here's the template for the cash flow statement. So I just want to point out a few things. We always title it with the company name and the type of statement, so statement of cash flows, then for what period it is. So for this one, it's for the year ended December 31st. So this one's for a full year. You can also do them monthly and quarterly. The cash flow statement is divided into 3 sections. So the first section is operating activities, the second section is investing activities, and the third section is financing activities. And then at the very bottom of our cash flow statement, we have our cash beginning of the year, our cash at the end of the year, and then our change in cash. So I always like to start at the bottom of the statement and just pick things off of the balance sheet and income statement as I go along. So this is your prior year. So that might not be intuitive for you, but usually we always put the prior year on the right, and then this is the current year. So it's really important, otherwise we'll get all of our cash flow adjustments backwards. So then if I see my cash amount, what I'm going to do is move these two amounts to my cash flow statement. So my $17,400 is my beginning of year. And my $54,500 is my end of year. Now, if I just work backwards, if I take the difference between both of them, so 54,500 minus 17,400, I have a difference of 37,100. So that's how much the cash changed. So I can put net increase in cash. So that makes sense. So if we start off with 17,400, let's just pretend in our bank account, then we put 37,100 into our bank account. That leaves us with 54,500 in our bank account at the end of the year. Now I have to figure out what caused that change. So let's start with our operating activities. So when we do the operating activities, there's actually 2 ways you can do it. One is called the direct method and another is the indirect method. But for our purposes, I am just showing you how to do the indirect method. And with that, we always start with our net income as our starting point. Now, if I go back to the question, the problem here is that they didn't give me an income statement, and that's usually where I find my net income. But they did tell me, they said net income is $91,000. So I can go ahead and put that amount in here. Now the next step is to add back items in this net income figure that aren't cash. So one that you might be familiar with is amortization expense. Also, when I see gains and losses on the income statement, those are also non-cash items. So we'll pick up the amortization expense. And again, they didn't give me an income statement. That is normally where I find the amortization. But what I can do is go to the balance sheet, and since they told me what accumulated depreciation was, I can just assume that the difference between the current year and the previous year is the amortization expense. So let's go ahead and take the difference on that. So plant and equipment, that is, or I want the accumulated depreciation, so let's just do 55,000 minus 33,000. So that is 22,000. So I am just assuming that that is amortization expense. So that's what I'll put onto my cash flow statement. Okay, now what I'm just going to do is add this, so the 91,000 plus the 22,000 equals 113,000. So I'm just going to put that total there. So those are our adjustments to our net income. So now it's like almost like our cash income, even though that's not a real term. Okay, here's the fun part. So before we do anything else on the cash flow statement, I'm going to make this just a tiny bit bigger. Now, what I want to do is take the differences between the accounts. So remember, this is prior year and this one is current year. So when I'm dealing with my assets, so these are all of my assets. Now I've already dealt with my cash and I've already dealt with my accumulated depreciation, so we don't have to include this in our calculation. But what I want to do is for assets, I want you to take your prior year balance and minus it from your current year balance. So in this case, if my accounts receivable, you see it went up. When I do 52,200 minus 54,800, that gives me a minus 12,600. So this here is just my cash. So if my accounts receivable goes up, my cash goes down. Let's try that again with inventory. So my inventory goes down, so I just compare it to the previous year. So then if I do prior year minus current year, that gives me 7,100. So that tells me when inventory goes down, cash goes up. Let's do that with the land. Land goes down. And so the difference is, or you can do prior year 87,000 minus 60,000. So that's a difference of 27,000. And we'll do the same thing with plant and equipment. Plant and equipment went up. But if I take prior year minus current year, then that makes the cash go down by 48,000. Now, I wish I could go through the entire balance sheet and use that logic, but it works the opposite with liabilities and equity. So when I'm doing liabilities and equity, I'm just going to do my current year minus my previous year. So this is for liabilities and equity. So if I look at my accounts payable, I can see that it goes down. So if I take my current year of 27,000 and then minus my previous year of 37,000, that gives me a negative 10,000. So if my account goes down, in this case, my cash will go down with liabilities and equity. The bonds, so I can see that the bond goes down. And if I take my current year, 118, minus my previous year, 158, that gives me a difference of 40,000. And then my common stock goes up from the previous year. And if I do my current year minus my previous year, I have a difference of 40,000. And we'll just hold off on retained earnings. We won't look at that one yet. So before I go back to the cash flow statement, what I'm going to do is put these adjustments onto the statement, but now I have to figure out where they go. I only have 3 categories: operating, financing, and investing. So I'm going to start with operating activities. So operating activities are your current assets and your current liabilities. So the accounts receivable change is a current asset. The inventory is a current asset. Land is not a current asset, so it doesn't go under operating. If I look at accounts payable, that's a current asset. So I don't see any other current assets here. So those are operating activities. Now, the other category is investing activities. So when I'm looking at investing activities, I'm seeing what type of long-term assets the companies are buying or selling. And so when I look at long-term assets, they're under the assets part of the balance sheet. And so in this case, I have land as a long-term asset, and I have plant and equipment as a long-term asset. And now we have to go to financing activities. So I need to know how these assets are being financed. So a company usually will rely on debt, for example, like bank loans, or equity, for example, like issuing shares. So when I'm looking at the debt and equity, I'm actually looking at my long-term liabilities and my shareholders' equity. So bonds payable is a long-term liability, and common shares is a long-term liability. So now that I have those categorized, and again, I'll just put O is the yellow, operating activities. I is the blue, that's the financing activities. And green, I is the blue, that's the investing activities, and green is the financing activities. So now I can just go and move these onto the cash flow statement. So I'll start with my operating activities. So my increase in accounts receivable, $12,600. So increase in accounts receivable, and that was a decrease of $12,600. Now what we can do is we can just check it off now. So once we've categorized this, we can cross it off. We don't need to look at it again. Now my inventory decreased, and it's positive 7,100. So now I've got inventory, and that was a decrease in inventory, and that was 7,100. And now I can cross that off. And then my other operating activity was the decrease in accounts payable and a decrease of 10,000. Okay, so now what I need to do is just add this row together. So the 12,600 and the 7,100, and then subtract the 10,000. That will give me my net change in non-cash working capital. So that's minus 15500. And now if we do the cash flow from operations, which is 113,000 minus the 15500, that gives me my cash in operating activities, so 97,500. And because this is positive, we're going to put this as provided by. If this was negative, then you would say used in. And so the reason why this is an important number is because it's telling me whatever product WAIF sells, this is how much cash it gets from just running its business. So 97,500. Now, they're probably going to use some of that to invest in more assets, but we'll take a look at their investing activities to really see how much they're spending. So the investing activities, again, was the blue. So when land goes down, basically what that tells me is they sold it. So you might see it show up as a drop down as a decrease in land or a sale of land. So let's go and do that. So I'm on my investing activities. Now I don't see anything here about land. So if it's not on that drop box, just go to the next one. And I see this one, sale of land. So I can put that number in. And it was the 27,000. And then the other one would be plant and equipment. So it looks like they bought more plant and equipment. So I'm assuming either something like an increase in plant and equipment or a purchase of plant and equipment for the title. And that's minus 48,000. And let's just see what they have here. So I have an increase in plant and equipment. And now let's add those two together. So if we do minus 48,000 plus 27,000, that gives me minus 21,000. So I'm going to say used in this time. So essentially, they spent $21,000 in order to invest in assets this year. And now we'll go to the financing activities. So this is the last part. And I can see that bonds payable decreased by 40,000 and common shares increased by 40,000. So when it increases for common shares, we usually call that an issuance. And when bonds payable decreases, we'll either call that a retirement or repurchase. So let's just go back to see what it says. So I have retirement of bonds, that's good enough. And that was 40,000. And I have issue of common stock, that's good enough, or common shares, and that's 40,000. So remember, the bonds was minus and the common was plus. So now I can cross those off. But you'll see I still have one more box. So the thing that we're actually missing is dividends paid. So I have common dividends paid. Now, you're thinking to yourself, how do I even know what that number is? I don't have the statement of retained earnings, which would tell me. So I can actually calculate it by opening up this retained earnings account. So I have 157,500 and 105,900. So I started off with 105,900. So let's do this. Let's open up retained earnings and move this 105,900 in as the beginning balance. And then move this 1,057,500 in as the ending balance. And now I know with retained earnings, it's beginning retained earnings plus net income, or minus if it's a net loss, and then minus all of your dividends. So that's your common dividends and your preferred dividends. So in this case, they gave us the net income number. It was that 91,000. So I'm going to add that in here. And so now I'm just going to assume that the difference to solve this is going to be my common dividends. So again, if we just do the calculation, what we can do is take 157,500. So that's the ending balance, and then just work backwards. Minus 91,000 minus 105,900. And that gives me minus 39,400. And that's the amount of your dividends. So just double check your math. So if you do 105,900 plus 91,000 minus 39,400, that should give us our 157,500. So I'll go ahead and move that onto the cash flow statement. Minus 39,400, and those were my dividends paid. So now I'll add these together. Minus 40 plus 40 minus 39,400 equals minus 39,400. And now I'll know if I did my cash flow statement properly is if I take my total from operating activities and my total from investing activities, and then my total, so that one was minus, so I'll say used in, from my financing activities, it should equal 37,100. So let's double check and see if we're right. So 97,500 minus 21,000 minus 39,400. That gives me 37,100. So our cash flow is balanced.